Let's get to Surge Energy, one of the latest Canadian energy producers to slash its dividend. We're joined now by the president, Paul Colborne. Paul, tell us, what is it like running an oil and gas company right now in Canada?
Well, thank you very much for having me on. It's trying times. This is my third major meltdown. The Russian ruble crisis in 1998, the financial crisis, and this is definitely the most difficult one. And it's a difficult time in Calgary. And the key thing for us to do is what we did is act quickly. I've learned this in my career, tell the truth. It doesn't look good at $30 oil. There's not much cash flow. Tell the truth and get over yourself. So we slashed our dividend first, I'm proud to say, and of any oil company in Canada. Mm-hmm. We cut our program in Q1 down from 26 wells to 19 to preserve capital. We had a great Q1 program with 2 new pool discoveries in our Sparky area, 19 consecutive good wells in a row. And we've been written up by 2 of the major banks as having one of the best hedge books of any oil company in Canada. Mm-hmm. So Andrew, that means we have a lot of our oil locked in at $58, $59 WTI until really well hedged until the end of September, which protects our cash flow. So taking those quick steps and being well hedged, Surge is in a good position to get through this this situation.
Sure. So you do, okay, we'll start off with a hedge. You have a pretty big hedge for, I think you said through September, Paul, but what about 2021?
We do have some hedges on in 2021, but we call it a waterfall. We try and hedge more near term because there's never been a time when crude dropped precipitously like this, mm-hmm. that it didn't recover at least 50% off the bottom within 6 months. Because really, Andrew, nothing works in the oil industry in the world below about $45 WTI, $50. So due to cost escalation over the years, that's the way mm-hmm. it is now. And these short dips down, so that's why we try and be well hedged for 6 months, a little less for the next 6 months, and mm-hmm. a little less for the next 6 months.
Paul, you may have seen, in terms of debt leverage, I think you are seen as one of the more vulnerable companies because TD put a heat map around last week. And they were talking about the then strip early last week, net debt to trailing 12-month cash flow. And they had you by Q1 of next year moving well into the red territory, well over 10 times debt to cash flow. So are you in survival mode right now?
Well, yeah, I mean, you can take $10 a barrel pricing and everybody will look even worse than that. So, I mean, strip was $58 6 weeks ago, mm-hmm. and 8 weeks ago oil was $65.50 when they bombed that Iranian general. So yes, if you have a massive spike down in crude, we look levered, and so do virtually every other oil company in Canada. Our hedging protects against these precipitous drops, but if it continues low for a super long time, we would go into kind of survival mode and that kind of thing.
What is the nature of your debt? Is it a line of credit or is it notes that mature? Or how does that work?
Yeah, we have a standard revolving credit facility that's in place. We have about $125 million a room on our bank line. And then we have 2 small convertible note deals that we've done, which are about $75 million of those. So that's our composition of our debt.
Have you had to lay anybody off yet, Paul?
No, good question though. In Surge, we're a very low-cost producer, so we have one of the lower, I'd say we're top quartile, or low quartile, if you will. Like, we have a very low G&A per BOE. It's $1.85, and that's quite low in our business. So we're pretty lean and running pretty lean, and as I say, with our hedges, we're just battening the hatches down and well positioned now to cash flow our assets until, as I say, 6-7 months out until we would have to start looking at any of those other decisions.
In the sense that you have higher leverage than other oil companies, is it fair to say that you've been caught out here, that you let debt pile up too much?
Actually, we paid our debt down, Andrew, $79 million over the last 12 months, from $461 million to $380 million. So, Serge, we were able to maintain our production, pay our dividend, and pay our debt down $79 million in the last 12 months. So, we already had a debt reduction policy in. Mm-hmm. A black swan event like this, which might be one of the worst ever, is really the issue for us, and that's why we hedge our production, especially as a DivCo. We want to make sure we lock in a lot of our cash flow.
Tell us, are we going to see bankruptcies, Paul, if this in the industry if this situation continues?
I think it's a certainty you're going to see some bankruptcies, especially in the Permian Basin in the U.S., where their debt leverage is higher than the Canadian peers. So I think we are in. I think you're going to just see it impact everybody from Canadian Natural and Suncor down to very small companies. Everyone has to react to a black swan event like this, and I definitely believe some that aren't as prepared as Serge with their hedging, way we cut our dividend quickly. If you delay in any way some of these key decisions, it's to your peril.
When you talk to industry colleagues, well, obviously for some of them survival is, and this is unknown. I mean, really, it's interesting. You mentioned the 90s, I think. The Asian crisis pushed oil way down. Does this remind you, though, of previous oil crises in any way?
That one drove crude oil prices down to $8, but it was a pretty quick recovery. I would say that this reminds me of those. This is worse, but both that and the financial crisis drop were difficult. This is probably the worst I've seen, and if I do believe, I think the demand destruction from the coronavirus is probably the real black swan for the oil industry to deal with. So,
thank you so much indeed, Paul. You're a busy man, and we really appreciate your giving us the time right now.